So today we are going back to basics on mortgages, everything you need to know about what is a mortgage and how to get one, most importantly. So let's go right from the start. Are you ready? Of course you are. Let's go. Hey everyone, welcome back to the channel. My name is Adam, I'm an expert mortgage broker. Today we're going to go back to basics on mortgages. We're going to talk about the basics of what is a mortgage and we're going to talk about how to get yourself a mortgage. First of all, if you find today's video useful, give us a thumbs up, subscribe to the channel and you won't miss the next one. We do a new video for you every week if we can. Also, if you're a first time buyer, then you are definitely going to want to check out my new book, The Ultimate Guide to Buying Your First Home. It's available on Amazon right now, but I've put a free download link for you so you can go and download the ebook and then that way you can enjoy it whenever you like. Absolutely free. So let's start with a very basic then. What is a mortgage? Well, a mortgage is just like a loan really. It's just like a loan that you'd go and get from a bank if you're going to want to buy a car or kitchen or something, except this loan is going to be quite a lot bigger than your average personal loan. We're talking hundreds of thousands of pounds to buy a house, so it's going to be a very big loan. Key difference is also from a personal loan is that it's secured, so it's secured on your property. Now the lender does this by putting something on the deeds of the property. So you may have heard people talk about deeds before. It used to be like a pack of physical stuff. Nowadays it's all electronic, what we call the land registry. But that mortgage is secured by what we call a charge on your deeds. So there's a few bits of terminology there. So the mortgage lender basically puts a note on the deeds of your property to say, well, the solicitor does it for them, but there's a note on there to say that you owe them some money, and they have what they call a charge. So that gives the lender some security because you can't sell your property without first paying back that charge. That's the lender's money to go back to them first, and then your money comes out second. That's your equity, and that's what makes it different to a personal loan because it's actually secured on something. With a personal loan, it's not secured on anything. If you don't pay the personal loan, the lender wants their money back. It causes problems with your credit score. We'll talk about that in a minute, but nothing really kind of happens. Whereas if you don't pay your mortgage, you can get repossessed. So that's what a mortgage is. Now let's talk about how to get one. So for me, there's kind of three key areas that are important when we're trying to get a mortgage. The first and the hardest one to get really is the deposit. So you've got to have a deposit nowadays. Years and years ago, there were 100% mortgages available. They're not a thing anymore. So we need a deposit. Now, if you've watched any of my other videos before, you'll know that we only technically need 5% deposit. So you can buy a house and get a mortgage with 5% deposit. That's 5% of the purchase price. Now, the more deposit you've got, the better. So the bigger your deposit, the lower your rate is going to be. And that is because it's all about risk for the mortgage lender. So we talked about a minute ago that they have their security, their charge on the property, and that's if they need to repossess you. So if you don't pay the mortgage anymore, they're going to take the house away and they're going to go and sell it to get their money back. Now, if you've put in 5% deposit and house prices dip down a little bit, then the chance of them getting their money back if they need to repossess you are less than if you've got, say, 40% deposit. Obviously that's a big extreme, but if you've got 10 or 15% deposit, then the mortgage lender is going to be a little bit safer. Now, the bigger your deposit, the lower your rate is going to be for that very reason. Now, the second thing we're going to need to get a mortgage is some income. So this comes under kind of the affordability section. So we're going to talk about income. So that's how much you earn. Now, you might be employed or self-employed. Let's kind of focus on employed for a moment. Now, if you only earn a basic salary, then that's fairly easy, really. That's pretty easy to work out for the lenders. It gets a little bit more complicated if you have some extra income. So if you have things like overtime, bonus, commission, it depends how often that gets paid as well. So if you get like a monthly bonus, that's fairly easy. If you get quarterly or half yearly or annual bonuses, then that can get a little bit more complex, and some lenders may not take all of that income into account. So it's very important to kind of get your income right and tell the lender the right income figures, the right split of basic salary and then extras on top. You might also get some extra income in the form of tax credits and benefits and things that can all be taken into account by some lenders, most lenders. So your income is it can be fairly complex depending on your situation. Now, with income then we have outgoings. So this is commitments. Now, I'm not talking about things like your phone bill and gas and electric. Lenders tend to use the Office of National Statistics to work out what you're likely to pay on those sort of things. But we're talking about things like loans, credit cards, car finance, student loans, anything that you've borrowed and need to pay back. That is going to be a commitment and affect your affordability. So when we go to a lender and work out how much we can borrow, we're going to tell them your income in the right split and how it's all broken down, and then we're going to tell them your outgoings as well and your commitments, and then the figure that's left is the amount that they'll use to kind of multiply up and work out how much you can borrow. As a rough rule of thumb, you can say about 4.5 times your income. That's only though if you're fairly straightforward. If you're fairly straightforward income and you haven't really got much in the way of debt, then 4.5 times your income is roughly where you're going to be. But if it's any more complicated than that, then you might find that actually you can't quite borrow that much. Now then, the third area that we need to focus on is your credit score. Now I say credit score, but it's not just score, because your credit score is one part. So if you go on Experian, TransUnion, Equifax, they're the big kind of 3 providers that the lenders all look at. If you go on there, you'll see a score, and that might be a star rating out of 5, or Experian use out of 999, whatever they use. That's going to be kind of green, amber, red, good, bad, ugly. That's kind of one thing, and people get hung up on the score, but the score isn't the be all and end all. In fact, I'll pop a link in the description of the video below to go and get a free trial for Check My File. Then you can go and see what your credit score is, your credit report. You can download that and see what it is. Free trial, you can cancel it after 14 days if you want to. But it gives you an idea of kind of where you are. So credit score is one thing. What we're more focused on is your credit conduct and your history. So your credit score is a record of all of the commitments you've ever had. Well, not ever, 6 years. So it's a record of the commitments that you've had. And so every time you take a loan or credit card or bank account or gas electric bill, anytime there's any element of kind of funding, borrowing, then it's going to be on your credit file, your credit report. And your provider, so let's say you go to Barclays and you take a personal loan, every time you make a monthly payment, Barclays will tell Experian and Equifax that you've made that payment and that it's up to date. But if you start missing payments or you're paying late, they will also tell them that. So that will show up on your credit score, your credit file, as a missed payment or late payment. And if you start to accumulate a few of those, then we're going to be in a little bit of trouble when we get to a mortgage. Now, you can get a mortgage if you've got some adverse, as we call it, or some bad credit. But we might need to go away from the high street. We might need to go to maybe a more specialist lender. There are options, so if you're in that position, don't worry. Things stay on your credit file for 6 years. So if you take a loan out, you take a 3-year loan out 5.5 years ago, in 6 months' time, that will be forgotten about. Now that will have gone, so we won't need to worry about that anymore. No one will be able to see it. Now, that can be useful if you have had some bad credit in the past, and you're coming up to it being 6 years old. At some point in the near future, it will go, it will be forgotten about. If you've missed payments recently though, and you try and get a mortgage, that could well have an adverse effect, because the lender kind of looks at this and thinks, well, they didn't pay Barclays back when they borrowed £5,000 from them. Are they going to pay our £200,000 mortgage? So that's the consideration that the mortgage lenders are going to make, and that's why your credit conduct is really important compared to your credit score. The credit score is a factor, but it's not the be all and the end all. Okay, so that's a fairly kind of brief whistle-stop tour of the 3 main areas that we need to look at and focus on when we get a mortgage. Hopefully that gives you a little bit of insight. If you want to know a little bit more about where you are or kind of on your journey, you can book a completely free, no obligation chat with us at any time. There's a link in the description below. It takes you straight through to our diary, so you can book that in anytime you like. We're always happy to speak to people and let you know, where you are on the journey. There's no cost for that, no obligation. If you want to go and learn a little bit more about who we are as well, you can go and look at our website. Again, there's a link in the description to that. We do a new video every week if we can, so hopefully I will see you next week on the next video. Until then, take care.